Now we've got to talk to a bear's perspective, because every day I give my perspective, I like to see what people are saying on the other side. And keep in mind, I've been very, very clear. I'm bearish on staples, I'm bearish on oil, I'm bearish on quite a few things. Things that did well in 22, I don't think are going to do well in 23. I'm looking for pricing power value, high free cash flow, high pricing power, energy, chips, automotive, autonomy, robotics, right? But it has to be high free cash flow. That's what I'm looking for. I'm also of the believer that we're in this Nike swoosh recovery. It's going to be very long. It's going to take longer than we expect, and it's going to be very volatile. But I think we're on a slow trend up, where maybe buy the dip makes sense again. And I think the real estate market is going to bottom probably 6 to 12 months after the real estate or the stock market. So in other words, more pain still ahead for the real estate market. So I'm bearish on real estate as well and real estate related services, but I'm bullish on certain stocks. And I'm also bullish on this idea that we're not going to see a Paul Volcker. I do think rates will probably have to go a little higher than we expect and for longer than we expect, but I don't see a Paul Volcker. But let's listen to what Sam Zell has to say, because he has some opinions about this potential recession we're facing, and I'd like to add my commentary, because that's what I do.
Zell of Equity Group Investments joins me here at Post 9. It's good to see you.
Good to see you, Sarah.
So there has been a bit of a rethink in the markets about recession. Is that something you still expect?
I haven't gone through that rethinking.
You're still negative?
Negative is the wrong word, but when you spread out free money for years at a time, you create, significant drag, and I just don't see how we're going to avoid a slowdown as that whole process comes to an end.
Yeah, and I want to be very clear about this. Well, he's making the argument that, look, we're likely to see a recession. Like, how do you not see a recession to get rid of this inflation, right? And I think this is where it's important, where you have to make your own analysis. Remember, I run an actively managed ETF. I sell courses on building your wealth. We happen to have a flash sale going on right now. I am a licensed financial advisor, but this is not personalized financial advice for you. I think you need to look at the markets and you need to ask yourself, there are two things, there are really two ways we go, two primary ways we go. Way number one that we go is basically, even if inflation comes down, it ends up coming back up, and then we end up having to get PV'd, which is Paul Volcker. Jerome Powell becomes the version of the early 80s where he raises interest rates to 10, 15, 20%, absolutely pushes the economy into a devastating recession, and everything's horrible. That is method number one, potential number one. Potential number two is we don't get a Paul Volcker, but maybe you get like a shallow recession. Okay, so if this is GDP right here, you get a slightly negative GDP. Staples get hit the worst. The stock market starts basically pricing through that recession and through that slower growth. It's like, okay, NVIDIA's earnings are flat. Does that mean we think NVIDIA's growth is gone for the next decade? Of course not. It means we had some pull forward. We go through some flat. We go through a little period of negative, and then we're fine again. Those are the two trains of thought right now. And you have to ask yourself, which train are you on? Are you on train 1 or train 2? And you probably allocate accordingly, okay? You probably, if you're on train 2, you're looking at high pricing power companies, high free cash flow. If you're on train 1, you're in bonds and cash. If you're in the middle, then you have a mixed portfolio. That's the way to look at it right now. All right, let's keep going.
Well, I guess the idea would be that the Fed would get really lucky and engineer a soft landing here, because the data's strong, the labor market is super tight, and inflation is starting to come down.
Yeah, but is the definition of coming down going from 9 to 6?
Well, yes, and then it has further to go. Sure.
Well, but the point is 6 is a
still
serious
very high
problem.
Yeah.
And
so you think the Fed's going to have to do even more than the market expects?
I think that I think the Fed screwed up by allowing it to the zero interest rates to go on.
And not only the negative zero interest rates going on, but the fact that they were still printing money. Quantitative easing was still happening when inflation was 6% in March of 2022. How stupid is that? Fed did make a big mistake. He's right.
For too long. I think we're just beginning to pay the price for that. And, it'd be nice to say that it'd be great if the Fed got lucky.
This video is sponsored by the programs on building your wealth, linked down below, and the experience to shadow me if you'd like to do that in person. Check out all of that, linked down below. You get lifetime access to all of the content, the course member live streams, and new information that's regularly added.
I've been around for 50 years, and I've never seen the Fed get lucky. All I've seen.
He's making the argument here that can the Fed actually engineer a soft landing and pull off getting rid of inflation? This would essentially make Jerome Powell a god. If he could pull off a soft landing, no recession, no mass unemployment, and somehow prices go back to stable, good luck. There are indicators that could be happening. I happen to lean towards the idea that that could actually happen. Or we get that soft recession, shallow recession, and the stock market prices through that. Now, who knows? Maybe that's Goldilocks, a fairy tale, or hopium, but let's keep going.
Seen the Fed do is mistake in terms of not acting fast enough.
So how do you take that view and prepare some of your companies and your portfolios for that eventual outcome?
I think you basically do two things at the same time. One, you prepare for higher interest rates and higher costs. And then at the same time, you also prepare for dealing with inflation. So a year and a half ago, we went to our companies and said, hard to imagine we're not going to have significant inflation, and we need to prepare for it, not respond to it. So in effect, we reached out and changed a number of our policies to prepare our companies for escalating costs.
Are you now preparing for disinflation, or you're just not convinced it's there yet?
No, preparing for disinflation would be a very optimistic thing to do at this point. I think it's going to take a while for the inflation pressures to ease, and I think that's what we have to look forward to.
Sounds like you think the stock market may be a little too excited about this notion that inflation is coming down and the Fed's going to pause.
The stock market has a long track record of being too excited about everything.
He's also not wrong about that, right? It's easy to be too optimistic about what's happening in the market. And yes, for those of you in the comments wondering, yes, this is live. But anyway, so this is really interesting. Now, prepping for higher rates for longer, that's in fairness where we look at this and go, do we really believe that the real estate market is going to go back to 2 or 3% interest rates on a 30-year fixed rate quickly? No. And the longer it stays high, the more pain comes to the real estate market. Is it possible that the stock market sees through it? Yes, but only if the stock market does not believe that number one is going to happen. If the stock market if right now somebody went to you and said, I guarantee you, scenario number one is not going to happen. Like Jesus Christ himself came down and said, world, fear not. There will not be another Paul Volcker. I would bet a lot of money that the stock market would skyrocket. And that's because the stock market is not afraid of number two. The stock market is afraid of number one. My belief. Let's keep going.
Both negative and positive. And I think, when the stock market reflected the fact that interest rates were going up and inflation was a problem, it was a little slow to pick that up. And then at the first opportunity, the stock market has gone and flipped and said, oh, everything is wonderful, and we're going to have a soft landing. I think both those extremes are unsupportable.
What about real estate, which is a big business for you? It's what you're known for. How much is real estate off the lows, if at all? Because we have seen mortgage rates come down.
Yeah, but think about the fact that if you had bought a house in January or February or last November, your mortgage rate would have been 2%. And today it's 6.
Yeah.
That's
still high.
That's a pretty staggering jump in a relatively short period of time. And I think there's just going to be, I think the real estate industry as a whole is got to deal with loans and all kinds of things that were the result of very, very low, unrealistically low cost of capital.
Yeah. So essentially he's making the argument here like, hey, look, you're still going to see prices decline, which reiterates what the Federal Reserve says in their FOMC minutes, where literally in the FOMC minutes, they say, and I'll show you the summary first and then I'll show you my citation. They literally say, real estate has the potential for large declines. This was just said yesterday, just released yesterday. Real estate has the potential for large declines. Valuations remain high. And then when they talk about stocks, they say the SPY is just slightly, well, it's above its median trend, which I think is propped up by Staples, right? So look, this is important. Here's the citation for that so you could read it yourself. You could take a screenshot of that right there yourself. Look, I do my best to provide as much value as possible every single day. If you want to take advantage of the flash sale for the programs on building your wealth, I'd love to see you in the course member live streams. We're going to do some fundamental analysis. We're going to jump into NVIDIA and Matterport now in the course member live stream. I'm going to make myself another cup of coffee, and that's exactly what we're going to do. I'd love for you to be a lifetime member. There's no recurring fee and monthly. It's just lifetime access. Whatever content I add in the future, you get. And I'd love for you to be there. I love you all. Thank you so much for your support, and good luck out there.